about New York City. It's my favorite topic. I'm a big fan of this market. I've only been doing business here 35 years, and only in one market for the most part. And it's a real honor and privilege to be able to address all of you here today. Full house, fantastic. Thanks to Goodwin and Columbia Business School for putting on this symposium. It's a great way to get everybody together and talk about what's going on in this market today. And, you know, the basic message, as you can imagine, is New York City has experienced kind of an unprecedented recovery over the past 18 months. And it's a confluence of factors, I think, that, you know, we recognized back in the middle of 23, after a few pretty tough years. Relatively stable interest rates, strong local economy, high tenant demand, and relatively low inventory. Now, that's a confluence I've only seen in my career once before, you know, and that was early 2000s. So I would define this moment as one of the best opportunities for investment in New York City, for New York City to shine. We put our money where our mouth is. Over the past 18 months, we were fairly, aggressive and fairly opportunistic. 625 Madison, 450 Park, 500 Park, 245 Park, buyouts of our partners at 100 Park, and 10 East 53rd. So we weren't shy about leaning into this market, and that doesn't include all the credit activity we did, nor the new development activity. So, you know, we've been pretty affirmative on this market for quite some time. I think we have earned the right to have a point of view, if you will. I think you can see here, hopefully not blocked out by this sign, a map of, not Manhattan, by the way. That's just the investment footprint of SL Green over the past 27 years. It's $126 million, 126 million square feet of equity and debt investment activity, both assets owned or owned and sold, assets that are currently collateral for our loan positions, or assets that have been repaid and or resolved. Now, there's a couple of takeaways. I'm a midtown player, okay? That's the market. Some of these deals we've kind of hit 2 or 3 times over this 27-year journey. And, you know, it's a transit-oriented approach to the business that's very near and dear to my heart, that we believed in way back in the mid to late 90s, and has paid off, you know, really well for our firm over the years. Just looking at 24 only, a little plug on SL Green, and then we'll sort of get into the market. This was 1 year's achievements. For us, I'd say, you know, better than average year, but we can do better. 188 leases signed, that's about one every business day, 3.6 million square feet. Increased portfolio occupancy. We bottomed in 2023 at about 89%. For us, that's kind of unheard of. We've added about 350 basis points since then, back to 92.5. We expect to finish the year close to 93.5, on our way back to kind of a normalized 95, 96, where we like to spend most of our time. We've closed asset sales over $1.3 billion. We did $5 billion of extensions, modifications, multiple transactions, probably 50 lenders involved in those extensions. Completed developments of 760 Madison Avenue, 1 Madison Avenue. We closed a discretionary equity fund last year. We have about $500 million closed, on our way to about $1.2 billion of total commitments. We did some acquisitions. We announced the global expansion of Summit. If anyone hasn't been here, anyone here hasn't been to Summit yet, it's inexcusable. Get up there, get there in the next, this weekend. Make a point. Go up there. You'll love it. I promise. And we're going to Paris with it in 27. And maybe notably for our shareholders, hopefully we have some here in the audience, 58% total return, which followed a 48% total return in 2023. So, good year. But we're here to talk about, 25 and forward. And, in that regard, for us now, it's not all about return. It's also about making important contributions to the New York City skyline, setting of new blueprints, if you will, in terms of design, amenitization, hospitality service. And in that regard, I'll take you through some nice photos of, skyline shots, point-top buildings, really, mark the skyline in a compressed photo here with, some of our great landmarks, including One Vanderbilt. It's something that can be seen now throughout the tri-state area. We had a particular focus on public and private partnership, both below grade in the transit hall and at the plaza, where we, try to bring nature in through installations we change out 5-6 times a year, artwork in the lobby, and in the transit hall, that's a Team Labs permanent installation, fine dining with Le Pavillon, again, theme of bringing nature inside. This is a Michelin star restaurant we opened in 2021 when everyone said, don't open a restaurant in 2021. We did. It's been highly successful since then. We followed on the heels with Joji Omakase, also Michelin starred in its first year of operation. Summit I mentioned, give away a few images of kind of the illusion and the fun that goes on there every day. 7,500 people a day, 2.2 million people a year. It's become one of the most highly coveted destinations in New York City, and we love it, and it's a happy place. People go there, and they go again and again and again. The repeat visitor, is something that separates this from being more than just an object, if you will, and it changes throughout the day, the night, into something that's really, quite fun and quite important for the city. It helps in the recovery. And adaptive reuse, okay? That's where my passion lies. New development gets all the attention, but I love breathing new life into older buildings. And One Madison is a great example of a building with over 100 years of age. We simply took 5 floors off a 4-story building, demolished the old core, built a new core, landed 500,000 square feet of glass and steel on top of a platform. And, you get this kind of transition, which I think was very respectful and harmonious to our Flatiron neighbors. Inside, again, all about elevated experience and hospitality. This is the rooftop, Les Jardins, Sur Madison, where now, we do amenities for the tenants during the day and great events on evenings and weekends, and another massive, plus, if you will, to this local area and to New York City. Big use of outdoor space, like to design these outdoor decks. I've got different architects and designers I work with to achieve these kind of unprecedented moments. And La Tête d'Or. Has anyone been to La Tête d'Or yet? Is there a show? Okay, I got 1 or 2, 3. What do you guys think? It's unbelievable. You guys, I was there last night. Place was pouring rain. Place was packed. People coming in 10 o'clock at night. Really fun steakhouse we did with Danielle Ballud. Little shorts. I said to him, can you do steak, Daniel? Can you do American steak? And he says, oh, Mark, I love to do steak. It's been my dream, my passion. I'm not just French culinary. I said, what do we call it? He says, La Tête d'Or. And I said, well, I don't know. That's not exactly what I thought it would be called. But you know what? It's a perfect name. It's his home park in Lyon, France. And it's a wonderful space that we designed with David Rockwell. And again, if you went there last night, you would see New York City en fuego, with these great. So another thing that's a must. 760 Madison, right around the corner from here. Very hard to build in a historic district on Madison Avenue. And almost, impossible. We got unanimous landmarks approval to build this 12-story retail and condominium complex. Giorgio Armani occupies 3 floors plus restaurant. Had the privilege of cutting the ribbon with Mr. Armani. I think it was October of last year. It was the first time he'd been in the city, I think, in 10 years. So, he gave me one of those face taps and says, "You've done good." So I think it was a successful project. And trying to advance. Beautiful, sinuous interiors. Very local product. This is not a pied-à-terre building. These were real Upper East Side, residents and families that bought in. There were only 12 cities. So New York's back. baby. We are back in a big way, all right? All right, so what does New York back mean? I'm going to just look over my shoulder here. First of all the jobs lost during pandemic back, and then some. OMB's estimate of new office using job growth for this year, 2025, 38,000. Their estimate, not ours. That would translate into about 5 million square feet of incremental demand conservatively. Directionally, their forecasts are almost always accurate. I hope they hit the number. That would be about double, the historical average. Tourism, I think it's going to be between 68 and 70 million this year. Again, record. You see it, you feel it out there. We feel it in all our hospitality venues. Spending money, restaurants, hotels, parties, venues, corporate events. New York Stock Exchange listed member firms last year, we call Wall Street firms, 48 billion in profits. A good year is 20. So, 2.5 times the amount of profits generally earned last year. And, area airports are at a record. Subway ridership is up almost to pre-pandemic levels. And, I think, the city has its mojo back. So how does that translate into the office market? First and foremost, New York City proudly leads the way in return to office. Okay, it's no coincidence, I don't think. New York is different than the rest of this country. We've had a pronouncement from every major finance, tech, business services firm that it's kind of time to get back to work and to max productivity. I think remote work was somewhat of a failed experiment. Not entirely. There'll be some lessons that will last, and there's a different balance in the work life that I see amongst my own firm and my tenants generally. But the recognition is that, we need to be back together. SL Green was always 6 days a week work from office through pandemic. And I'm looking at one of my colleagues here, right? Is that, you agree? And that's how we got things done. CBRE puts this out. It's the first time that I can remember seeing this quarterly report where all 5 major sectors in New York grew in the fourth quarter. 38% average growth. Renew and expand. I was just down in Hallandale, Florida, at a investor conference. Met with 75 shareholders in 2 days. So this is a breath of fresh air for me here today. And they want to know, do expansions outnumber contractions? There's really no contracting tenants in New York that I can speak of. I can't even, if you said to me right now, who contracted in the past 90 days? And for us, that's a lot of leasing. I don't know. Who expanded? IBM just took another floor at 1 Madison. Bloomberg just expanded to 900 and some odd thousand square feet at 919 3rd. I just announced 2 days ago, Newmark just expanded at 125 Park to a total of 188,000 feet. Ares, I expanded recently at the top of 245 Park after they had just signed a lease. And that's just scratching the surface. So if I had to guesstimate, I'd say expansions are outnumbering contractions about 5 to 1 in terms of number of leases. In terms of square footage, it's much higher than that because the companies that are expanding are the bigger companies taking big space, and the ones that are contracting are really the mid-size and smaller companies. Bears out in the statistics, in 24, it was about 22% ahead of the 10-year average in terms of total leasing, both new and renewal, 25 million square feet last year. I think that number is going to be much higher this year. Not quite back to peak levels, but somewhere between peak and above average. And, you would say, well, okay, if that's the case, why is the vacancy so high? Right? Why is the availability rate so high? Well, you got to, 1, dissect the numbers a bit, and 2, understand the perspective my comments come from. I'm not talking about New York City. I'm not even talking about Manhattan. I'm not even talking about Midtown. I'm talking about core Midtown. So I want to put an asterisk. Don't come out of here thinking, wow, all CBDs are doing great. It's not. It's really a New York phenomenon. Or everywhere in New York City is doing great. It's not. It's kind of a core Midtown phenomenon. But that's where we happen to be. I showed you the map, so that's where my commentary lies. New York City availability rate, 18.5%. That's high, right? Historically high and high in absolute terms. 400 million square feet of space in the city. Okay, that's close to 80 million square feet vacant. Yeah, that's pretty high. But, let's start to drill it down. Total Midtown. Okay, we're talking about two different CBDs. But we just took 200 basis points off of that. And then Class A, which is really, again, we're a Class A portfolio, so this is my metric, 12%. It's very close to an equilibrium market. I think about 10% is an equilibrium market. 12 is a pretty fair market. 12 is a market I could do business in for the next 10 years, no problem. But then you get into prime. And that's where it gets interesting, 6.4%. That is the tightest I've ever seen it in the Park and Plaza area. That's, again, 30-some-odd years. I've never seen it that tight. There's no space. There's no big blocks of space. So naturally, the demand is radiating to other parts of the city, as you would expect. And, this narrative, if you will, which I really hate to hear, well, it's just all around Class A trophy buildings, new construction. Well, it's not true. It's 85 to 90% of all leases signed in Manhattan last year were signed in buildings built before 2000. At least 25 years of age, probably on average 50, 60 years of age. 1,100 leases signed in older buildings. 21 million square feet signed out of 24 in older buildings. This is not a new construction phenomenon. I wouldn't want you to come away thinking what you read in the journal that, well, it's a flight to quality, new construction is raging and everything else is lying fallow. Not the case. I've got a pipeline right now of leases, and my pipeline is my Bible. 975,000 feet. 62 deals that I'm working on right now to try and close out in the next quarter. None of those are One Vanderbilt. Only a few are One Madison. Everything else, Gray Bar, 1185, 810, 7th Avenue, 220 East 42nd, that's where, 919 3rd, that's where the focus is. These are bread and butter Class A, core Midtown buildings. So, there was I think, more of an emphasis on new construction a couple of years ago, but right now it really is kind of a holistic market phenomenon. Looking forward, tenants in the market. These are tenants, I think, over 50,000 square feet, totaling 23 million square feet of space. These are real tenants, real deals. The broker reports might show numbers much, much bigger. I'm narrowing it to the tenants that are active. You can see here, Warner Music is in the news, Deloitte, Amazon, when they press the return to work button, that's 1 million plus feet of demand that they need and are signing leases throughout the city. NBA, others, all in the market. Most of that is growth. Some is consolidation, but most growth. And now you kind of layer over this demand, narrative that I just went through, limited to what I would call negligible new supply. And that's where I think it gets really interesting in terms of, let's see if I can advance this, in terms of trying to predict the direction of rents over the next few years. This is the delivery of new space, new commercial office space in Midtown Manhattan over the next 4 years. It's a long period of time, now through end of 28. It's like 4 buildings. Mickey Rabina's site is almost done. It's a beautiful site, by the way. J.P. Morgan showing leadership, building, 2 million square feet of office. Everybody thought when they were going to start occupying, which is this year, that was going to cause a vacuum of space elsewhere throughout the market as they relocated. But no, Jamie comes out and says, we're going to shut down the Bear Stearns building, take it down to the steel, rebuild that one as well. So the net increment of space during this 4-year period is like, 600,000 feet. And a couple of other, the Rolex building and one other. So a total addition to inventory of 1.2 million feet. 4 years. 300,000 square feet a year on a 400 million square foot market. Let's look out. Can everyone see that? Can you see over the sign? Or no? Yeah, okay. Let's look out at all the way out to 2032. Now let's expand to 8 years. Okay, some projects, you're aware of. Bear Stearns will be complete. Citadel and Vornado's and Rudin's building at 350 Park. Roosevelt Hotel site. Boston Properties site. I can't see. 7 million feet. A growing city, in my opinion, should be adding somewhere between 50 and 100 basis points a year to its inventory. That's 2 to 4 million square feet a year. Over 8 years, I'd be 16 to 32 million square feet to accommodate the 38,000 net new office using jobs. But this is nowhere near that, and the story's not complete because you have to factor in the residential conversions we talked about 15 months ago up on Business School campus at Columbia. And, this is about 6 million feet of deals just on this chart that have either are in process, announced, or let's call it rumored to go. Now, will all 6 million go? Yeah, I think so. But people say, no, this is a lot of talk, no action. Well, 753rd's on here. I take a little offense because we are doing it. And Pfizer is ahead of us. That's 2 million of the 6. Those are done. The rest are in process. And when you net the incremental inventory against these competitive office buildings, these are not, people describe this phenomenon as old, secondary, tertiary, 100-year-old, dilapidated, obsolete buildings downtown. No, not these. Okay, this is Pfizer's former headquarters. 753rd was a fantastic investment I made back in the early 2000s when I bought it from teachers, and could have gone on as an office, but decided to go resi. 711 Fifth, 767 Third. These are competitive buildings coming off the rolls. So you get to kind of a net increment over 8 years of 2 million feet. You want to double it, say 4 million feet? That's still 1% inventory over the next 8 years. I don't see how it could be more than that. I don't see how net new inventory could be more than 4 million feet over the next 8 years because new construction takes 5 to 7 years, period, end of story. So, you have to land a building from outer space. And people like to talk about Third Avenue. Well, look where the market, the beautiful, perfect market, has landed most of those conversions. On Third Avenue, where the prices are anywhere between $300 and $400 a square foot, which makes the conversion to go under the governor's new affordable housing bill. And that inflection point activated 7 projects. Okay, you take those 7 projects off of Third Avenue will be as tight as Park Avenue. Talking about that, let's go back to SL Green with a little bit of promotional eye candy and look at 753rd. Here's a project that is going to result in over 650 units being delivered in Midtown. We want to make it a best-of-class building. That means full amenitization, social club, high design, outdoor space, etc. And again, people say, but it's a 1950s Emery Roth building with big podium floor plates. You can't do it. So how do you do it? Well, it's not that difficult. You take that very deep, inefficient floor plate, and then you, well, see if I can do it here. Then you notch it out. You go in there and cut out the facade on 3rd Avenue, remove somewhere around, I think, 30 or 35,000 square feet of space, and we don't waste that space. We remass it on the west to make that western part of the building all glass curtain wall and very efficient. Now what we've got is a beautifully faceted building. You can see on the left and on the right the before and after that will program like this with all the co-working, fitness and wellness, social club, amenities, half an acre of outdoor space, which is what I have at 1 Madison, and pretty high design. It's exciting to work on a 50s Emery Roth style building. They did design some of those famous residences in New York, San Remo and otherwise. And it's kind of retro, but it's going to be really cool, and I think it'll be best of class in Midtown. And you get floor plates like this. Does that look inefficient to you, Mark Sandwick? No. Looks good, right? It's probably 78, 80% efficient. Tower, it's ridiculous. It's like over 85% efficient. Where we had some inefficiency in the other thing, we put tenant storage. How about being able to walk out your door, instead of paying $50 a foot for storage across the river, you pay $30 a foot and you have it 10 feet away. That doesn't sound inefficient to me. And a beautiful amenity with outdoor space that'll look something like that. That's actually close to the final design. So a little park in the sky, which is kind of something, a signature we're doing on top of all of our buildings. All right. The debt platform. I'm going to skip through this pretty quick. I just want to let it be understood that the opportunity I see is far greater than simply equity and development. I would say 50% of our firm right now is focused on credit platform. And we have extraordinary experience in originating debt and subordinate debt. I think $18 billion since IPO. Average returns over 12%, through highs and lows in the interest rate markets. And unbelievable segment of our business that allows us to stay extremely close to everything that's going on in the market. We have unbelievable relationships with our lending counterparties domestically and internationally. And, that led to us creating this special servicing platform, which is kind of a unique part of our business. We have over $20 billion in special servicing, either active or closed out. In markets like this, special servicing is, reigns because all these SASB, single asset, single borrower, large loans, which is what we're rated for by Fitch, S&P, and Morningstar. It's a unique rating and designation. I don't know if other equity REITs have it. I doubt it. We do have it. We have a group that just focuses on this. Loan origination, secondary market buys, special servicing, makes us sharper, makes us better, gives us real-time data, like day-to-day, over what's going on in the capital markets. And what is going on? Well, what's going on is $75 billion of commercial office maturities over the next 4 years. And a lot of those need to be restructured or amended or extended. Not all, but many. And some will have to be foreclosed. And that's a market, that you can be active in for the next several years and make some equity-like returns with debt-like exposure levels. CMBS issuances were nil in 2022. 2023 kind of had a little resurgence in 24. Year to date, $7 billion in 2 months. CMBS. Market's back. Where are those deals? Here's 6 of them. All right, big CMBS deals. This couldn't get done 18 months ago, 24 months ago. these 6 flew out the door. The AAAs are trading between 1 and 110 over. Pretty tight. Not historically tight, but pretty damn tight. You know, the rates on these deals are 6.25 on average. Not, you know, if you can't run a real estate business in New York City at 6.25, then shouldn't be in the business. You know, I mean, everyone talks about high interest rates. I don't think they're so high. You know, I look back, one of the greatest periods of investing I can remember is early to mid-2000s. Treasury was routinely 4 to 5%. Today it's 4.20. You know, you got to be able to make money at a 4.20 Treasury and a 4.25 SOFR. You know, a business can't exist only when the debt's free, in my opinion. Views from Asia. Just came back from, 10-day roadshow in Asia where we took, you know, all sorts of development, JV opportunities, acquisitions, summit expansion, and we went all over. Well received. I've been doing this for 20 years. Like, that's how long it takes to establish those relationships, and the relationships are deep. And you know, some of my takeaways: people want to invest in this market. Year and a half ago, office was, you know, taboo. They couldn't get it. They wouldn't have the courage to present it to their investment committees. Now they want exposure, and you know, they want it in size. And credit to these international investors, they don't reach for yield, they reach for quality. And that's what I love about, you know, making these trips, because, you know, you bring quality to them. These are long-term institutional and family players. That's what they want. You know, it's not a negotiation over the last 100 basis points of yield, because it's, you know, strictly, you know, an analysis of best markets, best sponsor counterparties, and best product. And that's the part of the market I like to deal in. You know, they, like many, had some investments that they had to take marks on in the first, 3 or 4 years ago, but a lot of that's washed through. You know, and there's a lot of new administration overseeing these books. They have tremendous inflows. They want to put it to work. The only commercial market I heard they're putting it to work on in the U.S. is New York City. Navigating uncertain times, I'll take some questions. I love the uncertainty. You know, we talked about it yesterday. This is where, you know, I can achieve relative outperformance. You know, I don't know how to say it, but I don't really, you know, if interest rates go down, it's going to inflate the value of my book, but it also diminishes my opportunity set greatly. You know, dislocation in the market is what you wait for. I was talking to Stan earlier. Every 10 years, there's like 2 good years to make money, and the rest is asset management. We're in that period right now, in my opinion. Could be wrong, but so far I haven't been, and hopefully it stays that way. We'll see. You know, I'm sure if I'm wrong, I'll be invited up next year, and I'll have to eat a little bit of crow up here, but if I'm right, you got to invite me back also. All right? And, you know, the big unknowns are the usual: political, interest rates, you know, tenant sentiment. I mean, that's mostly what drives what I look at. And interest rates, you know, from my perspective, are relatively stable at these new levels. You know, since they increased starting in mid-22, they kind of leveled off in end of 23, and they've been stable since. And I think it's an environment you can make money in. Politically, you know, we've had it, I think, you know, we've had a very good situation for the past 3 or 4 years. And you've seen a lot of improvement in this city. Has been very deliberate, not accidental. City of Yes, amended text zoning, the affordable housing bills, both for conversions and new construction. Other initiatives to improve safety and sanitation throughout the city, you know, at a time, you know, where I think both mayor and governor inherited a city that was, you know, in tough shape. And we've turned the corner, and it was a public-private partnership to be able to do that. Both governor and mayor have big proponents since day one of return to work and reviving the CBDs. And I thank them for that. So, you know, there's always something in the market giving a little bit of uncertainty. You know, will it cause a pause or not? We'll see. Obviously, at the moment, we've done almost 500,000 square foot of leasing in the first 2 months of the year, so I would say we don't see that yet. But every month, every day, you know, is a new day. But I think people will muscle through this because there's so much capital out there. The finance sector is doing so well. Tech is now first coming back. Like, tech hasn't been a big contributor over the past few years. This year, they will be. You know, we have a big venture capital sector right now, which we didn't have 10 years ago. AI, you know, ChatGPT just signed a lease over at, I think, Puck Building. So AI is here, and that's going to grow, and that's, I know, drove a lot of IBM's demand for additional floors in One Madison. It's a very exciting time to be in New York. You know, I'd like to open it up for some questions with the time we have left. Thank you.
Hi, Mark. How would you cobble together a $4 to $5 billion cap stack for office development today? I mean, a lot of the projects on your deck there, I mean, $4 billion plus. Spent a lot of time with one of your competitors trying to capitalize deals like that. Right. Absent a 50% plus anchor, how would you do it today? One Vanderbilt.
Existing product or new construction?
New construction.
New construction. Big demand for construction. You know, I would say you got to, I think you said a $4 billion development, you're going to have to cobble together, you know, probably $2 billion of debt. Probably takes 14 banks. You know, people love that construction product because there's excess return there. If kind of permanent rates on CMBS, you know, those spreads are 2.25 over, you're going to make 3+ on those construction deals. They're going to demand some pre-leasing to a certain extent and some top-level guarantee. So I like that because that makes it attainable for some but not for others, because you got to have the credit for that guarantee to have some meaning. And you're going to have to probably bring $500 million to the table yourself and go raise $1.5 billion from 2 investors.
What do you think that build to core return is today from?
The return on the equity?
Right.
You know, for new prime construction. So here's sort of the oddity of the current market. I can do kind of well-secured credit today at a 15, and you know, you can raise money for Class A trophy development at a levered 13.5. You know, less, because those returns, you know, the debt is great, but it's fleeting. Right? How long do you get to make 15% on debt? Maybe 18 months. Because the moment you make the deal, the borrower's working like crazy to repay you at that. And within 2, 3, 4 years, you're out of the deal. These are, you know, 13.5, a replicable return, 10, 12, 15 years. Those are the best investments in the city. And there's a lot of demand for that. Right sponsor, right product, some pre-leasing, you know, significant demand in New York City.
Mark, fantastic presentation.
Thank you.
I think you've made one of the greatest contributions to real estate and New York City in the history of the city. My one question for you is, why aren't you running for mayor?
I've always thought about, when I get that question, how am I going to respond to it? Because it usually comes privately. I think I can do greater good for the city doing what I'm doing right now, and I truly believe that. You know, thank you. You know, mayor's a tough job. I'm very close with Eric Adams. I think his vision, his goals were completely in the right direction, and I think he deserves a lot of the credit for the state of the city today versus what it was. But, a lot of the events have overshadowed that. Politics are tough in New York. I think if more business leaders thought they could go in and kind of, govern in a way to effectuate change within that vision on a rapid time schedule, I think more people would want to do it. But, the change is slow, and, even if you're not mayor, it doesn't mean you can't be a participant in that process and effectuate a lot of change. We were big proponents and activists of a lot of the bills that got, done over the past 3 or 4 years. And it was kind of privileged to serve on this blue ribbon panel that the governor and the mayor put together that led to the City of Yes changes. It was great to put 753rd out there as kind of, one of the aspirational what could be done with the new office to resi conversion bill. It was great to do One Vanderbilt, which really was the precursor to the Vanderbilt corridor rezoning and East Midtown rezoning. So, there's a lot we can do both at the city and state level. And there's many real estate companies and businesses in New York that are major participants in that effort, and I think have helped make the outcomes and differentiated New York's from other markets which maybe didn't have the same leadership or not as committed leadership to making those changes. So I'm kind of happy leading this little real estate company, and we got a big agenda for the next few years. I want to see it get done. We didn't talk today about the casino I'm going to put over at 1515 Broadway at Caesars Palace, Times Square. Come on, let's go, guys. Do you understand how transformational that is going to be for that market? Come on. $4 to $5 billion of investment in Times Square, with a halo effect that'll affect 350 businesses in that market. It's the only transit-friendly location of the 11 bids on the table. Something like a dozen subway and commuter lines all coming into Times Square. It's a district built for entertainment, and gaming. So, that's just one of, but there's a lot left to do. Got time for one or two more? I don't know. You guys tell me.
Thank you again. I would like you to address the residential part of New York City. As you know, the City Council enforces so many regulations on owners that diminishes our interest in residential investment. Could you address that, please?
Well, residential covers a lot of ground, so everything from high-end condo to, affordable. New York City is blessed with an unbelievable 24/7 market that attracts the best and the brightest and young people from around the world. So it's a constantly renewing, base of highly sought-after talent that, wants to live and work in and around New York City. And, my personal experience is funny. I've done a lot of residential, but it's a small part of the business. The project I completed at 7 Day downtown is achieving rents. We underwrote in the $80 a foot range. We get $105 a square foot for that. I think we generally are 99% leased in that market, both affordable and market rate units. It's at that part of the market, I think there's kind of endless demand. It just feels endless. So it's less a question about, will the deal underwrite, more a question of, can you build it, and because the sites are very tough to put together and assemble and get the rights, and, those projects are also 5 years plus. At the very high end, I had, sold out 10 condos at 760, achieved record pricing on the Upper East Side, but a lot of that is design. It's, in my mind, because there's a lot of condos in the Upper East Side. So branded product, very desirable today. People want high design, people want amenities, people want safe neighborhoods. So I can't really, in the little time I have, go into too much more other than to say we will lean into residential. Obviously, what I'm doing at 750, it's an $800 million deal. Didn't have to do it, right? We could have taken the easy path and just leased it up as office and done what we do to other buildings, but, you know, it's part, we're going to make very good returns there, and it's also part that the city needs the housing. I don't know what to say. It can't all be office. So, and, you know, by doing a project like 750, it benefits all the buildings we own around 750. I own a lot of stuff on 3rd Avenue, 919, 885, 800, 711, all on 3rd. So doing a project like that, I get the benefit of amortizing that $800 million, not only over that one project, but kind of, you know, it radiates and amortizes over those 6 projects. But the resi market is very good right now. One more?
Hi, Mark. Could you comment on the street retail environment in your buildings? Are you leasing up?
You know, I debated whether to put retail in or not. I just ran out of time. But, you know, I started doing street retail, high-end street retail, early 2000s. We kind of peaked in 2015. I think we're the largest owner of street retail in the city. And then, you know, the market in my mind kind of, you know, diverged. And we became net sellers in 15, and by 2020, we had probably reduced our inventory by 2/3 to only the prime, you know, assets. And that was a decision that worked out to be, you know, very good for us. What I didn't see, frankly, was the resurgence in bricks and mortar. Caught me a little bit by surprise. That market came raging back, kind of aided by COVID, but now, you know, persisting beyond. And the things that retailers are doing with their space today are unbelievable. It's exciting, you know, as a developer and as you know, somebody who appreciates high design over, you know, let's say solving to the lowest common denominator on a new project. The things people are doing experientially out there, kind of blurring the line between retail and social and wellness and food and beverage, is very exciting, and people are responding to it. You know, these, you know, high-end and luxury are doing unbelievably well right now. There's almost a land grab because there's really just, you know, office, you got a lot of office because you can vertically go 1,000 feet in the sky. Street retail is like beachfront. And, you know, and there's not a lot really left to occupy. So the vacancy rates have come back, the rents have gone way up, and now there's this motivation to buy your space, which I also respect, because the things they want to do in that space doesn't really lend itself to a lease. You got to own the space, and then you have to own your design program. So now, you know, you have people, companies out there paying $10,000 a foot and above for beachfront retail, and couldn't be happier because of the amazing things they're doing inside, adding in some cases hospitality or residences, you know, or art galleries or, you know, event spaces. It's not just a store anymore for a lot of these retailers. So I'm speaking about what I call high street retail. But within that market, you know, it's great, and you know, we're not doing new investment in that area, but everything that we have or are developing, you know, high street retail has become quite valuable. All right. Well, anyway, thank you today, and have a great rest of your day.